Volatility in the stock market comes with the territory of being an investor. Understanding the volatility of stocks and learning how to measure it is critical when analysing or creating your portfolio. One simple measurement is called beta. So before I give you examples, let's define what beta actually is. Beta is a tool to measure the relative volatility of a company compared to the overall stock market. So basically how up and down a stock's performance is versus the broad market. It's normally calculated using the company's fluctuations in share price over the last 12 months, and that's generally compared to the S&P 500. In simple terms, if the stock beta is 1, then this company is very consistent with the market, which means that it's not any less volatile, nor is it any more volatile than the market. However, if the number is greater than 1, then this would indicate higher volatility, and likewise, if the number is less than 1, then this would represent lower volatility. For example, if the stock has a beta of 3, then it's 3 times as volatile than the market. So if the S&P 500, for example, was expected to drop by 10% next year, you could also expect your stock to fall by 30% as well. So you times it by 3. And vice versa. If the market was to increase by 10%, your stock is likely to increase by 30%, hypothetically. To find the beta of your stock, open up the Trading 212 app, search the company, and scroll down to key ratios, and you'll find beta at the bottom. Here, Google has a beta of 1.04, which tells me that it's pretty much on par in terms of volatility compared to the S&P 500. Why is understanding beta important? Beta helps investors invest appropriately in the stocks that offer the right amount of risk and volatility for their portfolio. If you're comfortable to take on more risk in an attempt to get greater gains, then maybe a high beta stock is suitable for your portfolio. But in the same breath, a high beta stock probably wouldn't make sense if you're creating a defensive portfolio to reduce your chances of a big downturn. Using beta is not a perfect science, as there are many other factors involved with the company's fundamentals, but nonetheless, it is still helpful to know when creating or analysing your portfolio. So that's it for this episode, but please click and subscribe if you haven't already, but otherwise, I'll see you soon.